prices reached unprecedented levels at the start of the trading week, while European share markets moved sharply lower, as investors reacted to renewed geopolitical and trade tensions involving the United States and several European countries. Financial markets on Monday reflected heightened uncertainty after U.S. President Donald Trump announced plans to impose fresh tariffs on 8 European nations that have opposed his proposed takeover of Greenland. The developments triggered a shift in investor sentiment, driving demand for traditionally safer assets such as precious metals, while equities, particularly across Europe, came under pressure. Gold climbed to a new all-time high, touching $4,689.39 an ounce, equivalent to £3,499 during Monday's trading session. Silver also surged, rising to a peak of $94.08 an ounce. These levels represent record highs for both metals and underscore the strong demand for assets perceived as stores of value during periods of uncertainty. The sharp moves came as investors assessed the implications of escalating trade disputes and growing geopolitical strain between the United States and Europe. Precious metals such as gold and silver are widely regarded as safe haven assets, typically attracting inflows during times of political instability, economic stress, or market volatility. Over the past year, prices for both metals have risen sharply, supported by a combination of global tensions and broader economic uncertainty. Monday's gains were part of that broader upward trend, intensified by the latest developments surrounding U.S. trade policy and international relations. In contrast to the rally in precious metals, European stock markets experienced widespread declines. Investors appeared increasingly concerned about the potential economic consequences of heightened geopolitical tensions and the prospect of new trade barriers between major economies. The announcement of possible tariffs added to existing worries, prompting a sell-off in several sectors across European markets. The catalyst for the market reaction came over the weekend. On Saturday, President Trump announced that a 10% tariff on goods imported from Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland would come into effect on the 1st of February. According to the announcement, the tariffs could later be increased to 25% and would remain in place until an agreement regarding Greenland was reached. The move marked a significant escalation in trade tensions between the United States and a group of European nations. Reports following the announcement indicated that the European Union is considering a response in the form of tariffs on U.S. imports, with the proposed measures reportedly amounting to €93 billion, or approximately £80 billion. While no formal decision has been confirmed, the reports added to investor unease and reinforced concerns about a potential tit-for-tat trade dispute between two of the world's largest economic blocs. The dispute surrounding Greenland and the associated trade measures played a central role in Monday's market dynamics. As concerns grew, investors moved toward assets considered less risky, pushing gold and silver prices even higher. The renewed interest in safe haven investments reflected broader fears about the possible economic fallout from prolonged trade tensions and geopolitical disagreements. Looking at the longer-term picture, the price of gold has already risen dramatically over the past year. Last year alone, gold prices increased by more than 60%. This surge has been driven in part by concerns over global geopolitical tensions and economic uncertainty, which have encouraged investors to seek protection against market volatility. Monday's price action added to that momentum, reinforcing gold's status as a preferred asset during periods of instability. However, the rise in gold and silver prices has not been driven by geopolitical concerns alone. Other contributing factors have played a role in supporting the upward trend in precious metals. Expectations of further interest rate cuts have made non-yielding assets, such as gold, more attractive. In addition, central banks around the world have added hundreds of tons of gold to their reserves, increasing demand. In the case of silver, China's announcement of restrictions on exports of the metal has also contributed to higher prices by tightening supply. Market analysts have noted the significance of these developments. Susanna Streeter, chief investment strategist at Wealth Club, described gold's recent performance as a continued climb to fresh record highs. She said the metal's appeal as a safe haven asset has increased as concerns spread about the potential repercussions of what she described as aggressive U.S. trade and geopolitical policies. Her comments reflected a broader sentiment among market participants, who have been closely watching the interplay between political developments and financial markets. While precious metals continued their strong upward run, equity markets told a very different story. Shares across Europe were generally weaker, as investors weighed the risks associated with escalating trade disputes. In the United Kingdom, London's FTSE 100 index closed almost 0.4% lower. The FTSE 250 index, which includes a higher proportion of domestically focused companies, fell by 0.9% by the end of the trading day. The declines highlighted the sensitivity of European markets to international trade developments and political uncertainty. Within the UK market, a combination of financial firms and industrial stocks recorded losses. However, not all shares moved lower. companies linked to precious metal production benefited from the surge in gold prices. Shares in gold miners Fresnillo and Endeavor rose following the latest increase in precious metal prices, reflecting investor interest in businesses directly exposed to the rally in gold and silver. Across the wider European market, declines were seen in several key sectors. Shares in car makers, technology companies, and luxury goods firms experienced sharp falls as investors reassessed growth prospects in light of potential trade disruptions. The sell-off was broad-based, underscoring the extent of concern across the region. In Germany, the DAX index closed down 1.3%. Major car manufacturers were among the hardest hit, with shares in BMW, Mercedes-Benz, and Volkswagen each falling by around 2 to 3%. In France, the CAC 40 index dropped 1.8%, with luxury brands such as LVMH and Hermès among those recording losses. These moves reflected investor sensitivity to industries that could be particularly affected by changes in trade policy and international demand. Not all European stocks declined, however. Defense companies performed relatively well, with shares in Germany's Rheinmetall and France's Thales trading higher. The gains in defense stocks stood in contrast to the broader market weakness and highlighted how different sectors can react differently to geopolitical developments. Meanwhile, U.S. financial markets were closed on Monday due to a public holiday, limiting transatlantic trading activity and leaving investors focused primarily on developments in Europe and the implications of U.S. policy announcements. As markets digested the latest news, analysts continued to assess the potential impact of rising trade tensions. Danny Hewson, head of financial analysis at AJ Bell, said fears that a hard-fought trade deal between Europe and the United States might now be in jeopardy contributed to significant falls across European indices. Her comments captured the prevailing mood in the markets, where uncertainty over future trade relations weighed heavily on investor confidence. With geopolitical risks, trade disputes, and shifting investor sentiment dominating market movements, the opening of the week provided a clear snapshot of how quickly financial conditions can change in response to political developments. As the situation continues to evolve, attention remains firmly fixed on policy decisions, market reactions, and the broader implications for the global economy. In the next part, we will take a closer look at the deeper factors influencing investor behavior, the legal and institutional dimensions of the tariff debate, and how global economic forecasts frame the risks associated with rising trade tensions. As markets continue to absorb the implications of the latest tariff announcement, attention shifted toward the broader forces shaping investor behavior and the mechanisms through which geopolitical developments translate into financial market movements. The renewed focus on trade policy, particularly involving major economies, highlighted how sensitive global markets remain to shifts in political direction and international negotiations. Monday's trading session illustrated this clearly, as concerns over trade relations between the United States and Europe rippled across asset classes. The movement into precious metals reflected a familiar pattern seen during periods of heightened uncertainty. Investors often seek to reduce exposure to assets perceived as higher risk, such as equities, and instead allocate funds toward assets traditionally viewed as more stable. Gold and silver have long played that role, and the sharp rise in their prices underscored the scale of concern among market participants. The ongoing dispute involving Greenland and the threat of escalating tariffs added a new layer of geopolitical risk at a time when markets were already grappling with multiple sources of uncertainty. While gold and silver prices surged, the contrasting performance of equity markets underscored the uneven impact of geopolitical tensions across different segments of the financial system. European shares were particularly affected, given the direct involvement of several European countries in the tariff dispute. Investors appeared increasingly cautious about the potential consequences for trade flows, corporate earnings, and economic growth across the region. The tariff proposal itself marked a significant escalation. The announcement that a 10% tariff would be applied to goods from 8 European countries, with the possibility of an increase to 25%, signaled a hardening stance in negotiations tied to Greenland. The fact that the tariffs were framed as remaining in place until a deal was reached added to market unease, as it introduced uncertainty over both duration and scale. Investors generally react negatively to open-ended policy measures, particularly when they involve major trading partners. The list of affected countries included Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland. Together, these nations represent a substantial portion of Europe's economic output and trade with the United States. The prospect of tariffs on goods from these countries raised concerns about supply chains, export competitiveness, and retaliatory measures. Those concerns were reinforced by reports that the European Union is considering a significant package of tariffs on U.S. imports, estimated at €93 billion. Although those reports did not confirm any final decisions, Their emergence was enough to heighten anxiety among investors. Markets often react not only to confirmed policy actions but also to the possibility of future escalation. The idea of a large-scale response from the European Union suggested that trade tensions could intensify further, potentially affecting a wide range of industries on both sides of the Atlantic. These concerns were reflected in the performance of specific sectors across European markets. Industries that rely heavily on international trade or global consumer demand were among the hardest hit. Car manufacturers, technology firms, and luxury goods companies all saw sharp declines in share prices. These sectors are particularly sensitive to changes in trade policy, as tariffs can raise costs, disrupt supply chains, and reduce demand in key markets. In Germany, the impact was clearly visible in the automotive sector. Shares in major car makers such as BMW, Mercedes-Benz, and Volkswagen fell by around 2 to 3%. The automotive industry plays a central role in Germany's economy and is highly exposed to international trade dynamics. The declines reflected investor concerns about potential disruptions to exports and the broader implications of a prolonged trade dispute. France's market experienced similar pressures. The CAC 40 index fell significantly, with luxury brands including LVMH and Hermes among the companies recording losses. Luxury goods firms often depend on global consumer spending and international tourism, making them vulnerable to economic uncertainty and trade-related tensions. The decline suggested growing caution among investors regarding the outlook for these businesses in a more volatile global environment. In the United Kingdom, the FTSE 100 and FTSE 250 indices also moved lower, though the scale of the declines varied. The FTSE 250, which includes a higher proportion of domestically focused companies, fell more sharply. This indicated concerns not only about international trade, but also about potential knock-on effects for domestic economic conditions. The mixed performance within the UK market highlighted how different segments of the economy can be affected in different ways by global developments. Despite the overall weakness in equities, certain stocks bucked the trend. Shares in gold mining companies rose in response to the surge in precious metal prices. Fresnillo and Endeavour both saw gains, reflecting investor interest in companies positioned to benefit directly from higher gold prices. This divergence within the market illustrated how shifts in commodity prices can create winners even during broader market downturns. Elsewhere in Europe, defense stocks recorded gains. Companies such as Rheinmetall in Germany and Thales in France traded higher, standing out against the general market decline. While most sectors struggled, defense firms appeared to attract investor interest, possibly reflecting perceptions of increased geopolitical risk. The rise in these stocks highlighted how geopolitical developments can influence investor expectations differently across industries. Meanwhile, U.S. markets remained closed due to a public holiday, limiting immediate reaction from American investors. The closure meant that European markets were the primary venue for price discovery on Monday, with investors there responding directly to the tariff announcement and related developments. The absence of U.S. trading activity did not, however, diminish the global significance of the news. As attention remained firmly focused on the implications for transatlantic relations, analysts continued to assess the broader context of the market reaction. Danny Hewson of A.J. Bell pointed to fears that a previously hard-fought trade deal between Europe and the United States might now be at risk. She noted that these fears contributed to the significant falls seen across European indices. Her comments reflected concerns that the latest developments could undermine progress made in trade negotiations and increase uncertainty for businesses and investors alike. Beyond the immediate market response, attention also turned to the legal and institutional framework surrounding U.S. trade policy. The U.S. Supreme Court is expected to rule on whether President Trump exceeded his authority by imposing some tariffs under the International Emergency Economic Powers Act. According to reports, the decision could come as soon as Tuesday. The potential ruling added another layer of uncertainty to the situation, as it could have implications for the legality of existing tariffs. Hewson noted that such a decision could bring another major shift in market sentiment if the court were to strike down the tariffs. While no outcome has yet been determined, the prospect of judicial intervention highlighted the complex interplay between political decisions, legal processes, and financial markets. Investors are closely watching these developments, aware that legal rulings can significantly alter the policy landscape. At the same time, international institutions have continued to highlight trade tensions as a key risk to global economic growth. The International Monetary Fund, in its latest World Economic Outlook, identified trade disputes as one of the main threats to the global economy. Although the forecast was prepared before the most recent tariff threat emerged, it described the global economy as steady, while cautioning that risks remained. The IMF pointed to several potential challenges, including the possibility of an end to the artificial intelligence-driven growth boom and a flare-up in trade tensions. The latest developments appeared to underscore those concerns, as markets reacted swiftly to the prospect of escalating trade disputes. The IMF's assessment provided a broader backdrop against which Monday's market movements could be understood. As investors weighed these various factors, the focus remained on how political decisions, legal outcomes, and economic forecasts intersect to shape market dynamics. The sharp rise in precious metals, the decline in European equities, and the sector-specific movements all reflected a market environment marked by caution and uncertainty. In the next part, we will continue examining the remaining elements of the news story, including the wider economic implications outlined by global institutions and how these developments fit into the broader narrative of global financial stability, before moving toward a comprehensive closing summary. With geopolitical risks, trade disputes, and shifting investor sentiment dominating market movements, the opening of the week provided a clear snapshot of how quickly financial conditions can change in response to political developments. As the situation continues to evolve, attention remains firmly fixed on policy decisions, market reactions, and the broader implications for the global economy. In the next part, we will take a closer look at the deeper factors influencing investor behavior, the legal and institutional dimensions of the tariff debate, and how global economic forecasts frame the risks associated with rising trade tensions.